Everything you're about to hear is for education and entertainment purposes only. Whilst we are licensed, we're not aware of your personal financial circumstances. Any advice is general advice. Equity Mates operates under Australian Financial Services Licence 540697.
Equity Mates!
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Welcome to another episode of Equity Mates, a podcast where we explore what's possible in the world of investing. If you've just joined us for the first time, a massive welcome to the podcast and to the Equity Mates community. My name is Bryce, and today I am sitting down with the Global Head of Sustainable Investing at JP Morgan Asset Management. Now, Ren was still away while I was doing this interview, so it is just me today, but I really enjoyed this episode. I had the pleasure of speaking to Jennifer Wu. So Jennifer is responsible for the firm-wide strategic efforts in building a global sustainable investing platform at JP Morgan Asset Management. She has extensive experience in the space, having previously worked at BlackRock's sustainable investing team and at the Asian Development Bank in the energy sector of the Central and West Asia department. So in today's episode, we cover off JP Morgan Asset Management's approach to sustainable investing. We look at the core ingredients of their sustainable investing strategies, as well as talk about the evolution of sustainable investing and how the landscape has changed over the past decade, some of the major trends that are shaping the future and where the money is flowing. We also make a distinction between sustainable investing and ESG and look at some of the ways in which JP Morgan themselves are trying to achieve that net zero by 2050 and the initiatives in place. So we cover a lot in here, and towards the end, we bring it back to us as individual retail investors and how we can incorporate the ESG criteria into our own portfolios. And Jennifer provides some advice on how we can take the factors that we discuss and practically implement them through JP Morgan's sustainable ETF, TEMP or T3MP. So stick around for that towards the end. And as I said, thoroughly enjoyed this episode, as I hope you do too. Well, Jennifer, welcome to Equity Mates.
Well, thank you, Bryce. Lovely to be here.
So I want to start with a would you rather.
Okay.
Would you rather have the ability to see 10 minutes into the future or 150 years into the future?
Oh, 10 minutes for sure.
Okay.
Yeah,
Why's
that's
that?
all I need, because if I know too much about my future, I may not be able to do anything. But if there's like good food on the horizon or just something beautiful, I would be enjoying the next 9 minutes as much as possible. Yeah, and looking forward to it.
What about from an investment standpoint?
The same, I would say, right? Because the joy about investment, especially in my field, is not knowing what's going to come next, right? So if you get it right, you feel so good about yourself. If you don't get it right, it's okay. Probably not a lot of people also get it right or wrong. Yeah.
Nice. Well, we're here today to talk about sustainable investing, and it's something that we haven't done a deep dive on for a while at Equity Mates. So I'm looking forward to getting stuck in. But before we do, are you able to share a bit about your background, your role at JP Morgan Asset Management, and how you became involved in sustainable investing specifically?
Happy to. So I currently head up sustainable investing at JP Morgan Asset Management globally. And I oversee our research work, stewardship, and what we call client solutions. Before JP Morgan, I was working at BlackRock, also doing sustainable investing. And really, like, my journey really started when I first got into Asian Development Bank. But back in the days, the word ESG or sustainability didn't really exist, right? So Asian Development Bank, like the World Bank or any other multilateral agency, the objective is poverty alleviation. So I was in the energy sector covering Central West Asia. So all the ex-Soviet Union countries, Afghanistan, Pakistan, the Caucasus. So building power plant transmission line, but basically like project finance type of work. So that's a little bit different from some of the peers that I come across these days who work in sustainable investing. Quite a number of them used to be either governance experts or, being investing in like traditional ethical investments or SRI. But by way of training, I started my career as a research analyst, worked in private equity, venture capital, merger and acquisition before I got into Asian Development Bank.
Wow, so quite the experience. You said that sort of sustainable investing wasn't a thing sort of early in your career. How old would you, or give us a lifespan of sustainable investing, so to speak? How old is it?
I would say the word ESG really became fashionable probably about 10, 12 years ago. And it was used to describe a new way of thinking around sustainability, right? Which is recognizing the fact the world is fast changing. So how do we start considering issues that you can't easily capture by just looking at financial statements of companies or, listening to earnings, and then be able to factor those into your investment considerations. And a lot of these changes that we started to see it's happening in the world is related to, changes in our environment, like climate change, for example, and then also better awareness of how human capital management is actually really important in order for companies to be able to operate effectively and generate good profits, and not to mention the good old G of ESG, so governance, right? You want to have good governance both at the management level as well as at the board level. To ensure effectiveness and all of that. So it's a way to, I would say, a broader a recognition of how there are a number of non-traditional financial metrics that do impact how companies operate and the outlook of their profitability, and then starting to integrate those systematically, which is very different from the traditional ethical or socially responsible investing.
Yeah, I think that's where, particularly when you're early in your investing journey, you start at that space, the socially responsible, and it's, and then you understand the E, the S, and the G a little bit more. How does JP Morgan Asset Management approach it? And I guess what are some of the core ingredients that define sustainable investing strategies for you guys?
Yeah. So it's very similar to the concept of how can you become a better investor if you invest sustainably? At JP Morgan Asset Management, we basically break it down into two different approaches. One of which is, if we are able to have a better understanding of these issues, can we actually better manage risks or generate better return for our clients? So not specifically have ESG or sustainable objective in mind, but just try to do investment in a slightly different way by incorporating these unconventional issues. Can we actually generate better return? The other approach that we've taken is also recognizing the fact that we actually have more and more clients who have a secondary objective. So not only they want us to be able to generate return, but they also want us to be able to create some kind of a positive environmental or social impact, right? And that's quantifiable. So a dual objective type of investments. And they're okay with, to a certain extent, some kind of return trade-off. So that's a very different type of investment strategies or products than versus what we had in place. So we had to basically create a whole new set of products for clients that have a different kind of objective. So that these are the two approaches. And on the first one, that's really where I spent most of my time, I'd say, in the last 5 years. If you are a equity investor, right, invest in the equity market, you look at a wide range of things. The reality is there's just so much more information coming your way these days. How are you able to systematically capture all of these issues and then make that investment decisions has becoming more and more challenging. So one thing that we are able to bring to our, my team is able to bring to our colleagues within JP Morgan Asset Management is to help them aggregate a lot of these unconventional information related to environmental, social, and governance, basically embed them into the systems that they use such that they can pull the data points and build those into their cash flow or DCF models or credit rating models as they see fit, and then make that recommendation to the portfolio managers.
Interesting. Some asset managers do all of their investment through the lens of ESG. Are you saying that you just provide this information to your managers and it's up to their discretion how much they use it or not?
That's correct. Because ultimately, the portfolio manager's decision has to align to the specific objective of the portfolio or the fund that he or she is managing, right? And I cannot decide that for him or her. The best thing I can do is to provide that information or data points such that he or she can make better decisions. There are instances whereby, for example, we have a process in place whereby we have systems in place for the research analyst to capture these information using the data points that we provide to them to make a recommendation on the ESG credentials of a particular company. The portfolio manager can then, based on that, make an investment decisions together with many other things that they need to do to optimize the portfolio. And then we also have an independent monitoring process, not done by my team because it has to be independent. It's done by our internal risk team, who on a quarterly basis would evaluate every portfolio. So they would sit down with the portfolio manager, look at, okay, are you in line within your risk budget? Are you in line with your portfolio's objectives? And if you say that you are effectively managing financially material ESG risks, why do you still invest in so many companies that have a lower ESG scores according to our own internal assessment? The portfolio manager will have to be able to substantiate why this is the case, and sometimes it's because they have a portfolio that requires them to trade quite frequently. But these stocks, if you like, or companies that have ESG risks, the time horizon might be slightly longer, right? So for them, it's not financially material, so they can still hold these companies.
Yeah, right. So you can really start to see how leveraging this information can give you a bit of an edge over managers or individuals who just look purely at financials and make investing decisions off the back of that.
That's correct.
Yeah.
And if I can just add, we obviously also have portfolio managers who manage what we call dedicated, sustainable, or green portfolios. Their starting point would be they would already as a first step, take some of these ESG information to exclude companies that fall below a certain threshold.
Positive and negative screens.
Correct.
Yeah. So how have you seen the investment landscape evolve over the last sort of decade, and what are the trends that are really shaping the future? Where is the money going?
Yeah, so I would say the biggest change is that in the recent 12 to 24 months, there's finally a recognition that sustainable investing is investing. And what that means is that it's not immune from any of the macroeconomic shocks, right? So for example, inflation, interest rate, all of these things.
Was there a belief previously that wasn't the case?
I would say if you asked me this, or anybody, this question 3 years ago, I think a lot of people would say, well, it is possible to both do well and do good.
Gotcha.
Right?
Yeah.
I.e., a lot of these companies that are at the forefront of contributing to a transition to a low carbon economy, for example, many of these companies are growth stocks, right? But in the current macroeconomic conditions, or in the last couple of years, they didn't do very well. Not because of their green credential, but because of other macro conditions. So in a way, when you want to invest in sustainable leaders, that's the other element you have to take into consideration, right? You don't just blindly select sustainable leaders without thinking about what the return profile could be. Right? Ideally, you want to be able to tap into companies that can generate good cash flow, but then also have a very good green credential. But it's not always possible because market is quite cyclical. So I think that the recognition of how sustainable investing is investing as well. Right? It's not just there to generate a positive ESG outcome. It is supposed to generate return as well. So those funds or investment strategies that have proven to be doing a better job in terms of investment return than their peers are gaining momentum from investors. So that's one. I guess the second thing is also that this move from exclude to include. And I think the whole concept of exclusion really was born out of the traditional ethical investing SRI, whereby you would exclude companies that don't align with your values or your beliefs. And so that was almost like the first approach that was adopted by sustainable or ESG investing. But it has really changed quite a lot in the last 5 years, right? Where people understand that, by having a seat at the table, stay invested in companies who may not be so sustainable today, but because you are a shareholder or a bondholder, you could actually work with the company as they continue to improve their business operations and be able to benefit from that uptick, right? So that is something that I think really describes a new wave of sustainable funds that may not have a very stringent set of exclusionary screens because they're really focusing on the inclusion criteria. So that's the second change. I think the third one is we went through this phase of defining what is ESG, what is sustainable. I think the market got really confused. But there is now, at least in the institutional investor space, right? When you call a fund ESG integrated, mostly what that means is that this fund is considering financially material ESG factors. It doesn't mean that this fund has a mandatory exclusionary screen. It doesn't mean that this fund is trying to achieve an ESG objective. When we say a fund is ESG integrated, it simply means that it's taking into consideration all financially material factors, including ESG, wherever applicable. But when you say a fund is sustainable fund, that typically means that there is a minimum exclusionary criteria that needs to be applied, and the fund is trying to seek not only financial outcome but also a sustainable outcome as well.
I think that's a really good point, because I think a lot of people, early stage investing, the jargon can be overwhelming and confusing, and seeing those two things next to each other, it is easy to assume if they say they're an ESG fund that you're putting in your money in to someone who's you're probably wanting to do the sustainable approach, but you're getting confused with the jargon and terminology. And I think that distinction there is clear. I think what is also a trend, I would say, over the last 18 months, maybe 2 years or so, is the proliferation in ESG scores that come from different asset managers and the way of defining ESG within each organisation. How do we navigate between the way that you guys define ESG versus another asset manager?
Yeah. And it's also not just asset managers. You have third-party ESG rating agencies.
Very true,
right?
Yeah.
So I'd say at the start of the journey, a lot of the ratings, be it provided by third parties or developed by asset managers, these ESG ratings combine some elements of financially material ESG considerations and then some elements of positive or negative ESG outcome that this company's product and services can have on the environment or to the society. And these are two separate things, right? So if we take the case of a tobacco company, a tobacco company can actually have a good ESG score if the score only defines how good the company is at in terms of managing natural resources, human capital, and whether the company has a good governance structure in place. So in that respect, a tobacco company can actually have a good ESG score. But if the ESG score also captures the externalities,
society harm,
then theoretically that ESG score wouldn't look as good. Yeah. So I think at the start of even for us, when I first started the journey, looking at different scores provided by third-party vendors, you will find that the methodologies are actually different. Some of them don't capture any of these like externality type of things. Some of them combine these two into one, and it's just like, well, how am I going to make use of it if I don't manage a ESG fund, right? So, which is why, like for us, we had to develop our own scoring system. So we actually have a pretty distinct line between what's financially material versus what's not financially material. So the proprietary ESG assessment framework that we have in place, which ultimately get translated into a score, is done by our investment teams. And then we also have a data-driven approach to aggregate all of that insights into a single score. So the idea is that we're assessing companies on issues that we know could impact companies' projected cash flow, credit rating, reputations, etc. If it's an issue that has zero impact on companies' financial, it's not material. It's not in our system. Yeah. And we have a separate system to evaluate the impact of these companies' practices or products and services, but that's a separate, what we call like outcome-oriented assessment.
Do you think the industry will ever get to standardize, or do you guys want to keep it separate because it's your kind of like secret sauce?
I think it's very hard to standardize, right? Because even though we have our own scoring system, The reality is most of the scoring system is done at sector or industry level. So in our scoring, we already have a way to assign different weightings or even assign different metrics depending on the sectors or industries that a company's in. So for example, in banking, you probably really want to focus on human capital management, for instance, right? You probably wouldn't focus so much on how much greenhouse gas emission there is as a result of the electricities that we use. But for utilities, that's a completely different thing. But every company is different. So even within banking, how do you know? And we know that there is geographical differences determined by just like distribution of natural resources as well as different policy regimes. We allow our research analysts across equity and fixed income to be able to assign like a secondary materiality weighting at the individual company level. Right. So that's a very subjective way of thinking about it. I think it's very hard to harmonize across industries because everyone has a very different view, and we update these scores on a real-time basis. But I do think what can be standardized is we know that in the broader category, what are the E, S, and G issues that matter, right? So I think what can be standardized in the industry is disclosure. We only want one way of calculating greenhouse gas emission. There shouldn't be a secondary way. We know that which are the categories of scope 3 emissions that matter the most to a particular industry. So we want some kind of standardizations around what needs to be disclosed by companies around the world. So the work done by the International Sustainability Standards Board is really, really interesting and important, right? The whole effort of trying to embed some of these financially material information into mandatory financial reporting. That will help us. We can then make the decisions on whether it's important or not.
I love that because often wading through the sustainability reports that companies put out can be sometimes like reading a piece of fiction. I think what they say, the way they present it, it's very hard to actually compare apples with apples in some instances. So
totally,
I love that.
And they don't have any incentives to say anything bad about themselves, right? But if you make disclosure standardized, whether it's good or bad, they have to disclose, and it's fact-based, if you like. Yeah.
So one part of sustainable investing is the engagement piece, highlighted as a key aspect. I'd love you to sort of articulate how it's important to you guys, and potentially if there's some case studies in which you can, well, firstly define it, and then maybe provide some examples on how you guys are actually engaged in engagement.
Actually, a lot of people ask me, how is engagement special? Don't you already have like research analysts or portfolio managers meeting companies that you invest in, day out? That's true. The key difference between engagement versus research due diligence meeting is that engagement is about negotiation, whereas research due diligence meeting is really about I go in, talk to the CEOs or the investor relations, identify a number of issues or information that I need. I come back, update my discounted cash flow models. Whereas engagement is intentional, right? So you come in with a objective. We have already done the internal analyses on, okay, if the company if they are able to make change in this respect, like, decommission fossil fuel power generation at a faster rate and a cost-effective rate than its peers, because it's incentivized by regulations, then we believe that it can actually outperform its peers. So we have that prior. We want the company to do that because that's going to generate better shareholder value. Yeah. So we go in. Companies may not agree with you, so it's a matter of negotiation. So it's a slightly different kind of skill set, right? You want to hire people who comes from, like on our team, we have people who was a career analyst on both on buy side and sell side, so they know how to analyze company. They can come up with a prior. Who can work with our investment teams. But you also need someone with negotiation skill. Otherwise, it's very, very difficult. And it's almost a bit like a dance, right? It's not, you probably won't be able to get there the first time. From our experience, it typically takes, especially when it comes to engaging with companies on decarbonization, be it utility companies, mining, or energy companies, it takes about 18 to 24 months.
Oh, wow.
Yeah, because if you think about, they are capital intensive, right? Yeah. In order for them to make plans to gradually shift their business operations, it takes time. It takes a lot of planning and consideration on how do they do that. So that's the first one. Engagement is different from research because engagement is intentional, trying to achieve an objective through negotiation. The second thing is that I think another recognition from the market or realization is that engagement is not a tick-the-box exercise. I think in the early days of engagement, you would have, regardless of whether you are an active manager or passive manager, regardless of whether you're a manager or asset owner, you have one goal. So for instance, in the early days of climate engagement, we all wanted companies to start disclosing the type of climate-related risks that they're exposed to, right? Not getting them to set a target or anything, just disclose so we can better analyze. That's pretty straightforward, right? So a lot of the engagement is really about, do you have a climate report, right? Do you disclose scope 1 and 2? Whereas now engagement is very, very different. The example I gave you, like every company that has a net zero targets is trying to decarbonize, but they may be at very different pace, and the internal resources that they have may actually look really different. So the engagement has to be very nuanced, right? It's very company specific. We have to do a lot of work before we go and engage with a company on a specific topic. I guess the final thing I would say is that engagement, you could fail. And I know that the hardest bit for us is to be able to measure success of engagement, because I know that we're not the only shareholder that's engaging with a company. There are many other shareholders. So it's quite hard to claim that it was because of us. This company decided to change. And you don't always win. But, we engage with companies because we think the issue is quite important, be it driven by regulations or reputational risk or whatever it could be. So one example I could give you is that we started a engagement program with battery makers last year on the issue of child labor in the cobalt supply chain. And the prior is that the transition to a low carbon economy is where we need to get to in order to avoid the worst from happening. So, but we also want to avoid or try as much as possible to make sure that we don't create new externalities with this green transition. So, we know that battery is just so critical and to this whole green transition story. And cobalt is one of the most critical, important minerals, right? 70% of cobalt is supplied by Democratic Republic of Congo, and there is serious allegations around child labor issues in the mines that they have. So engaging with the companies on supply chain, try to promote them to do a better job at external auditing, and then also have a robust system in place to when they select vendors and all of that. It's going to take multi-years because we're talking about not just a company-specific issue, right? It's system-wide and it's country-level geopolitical issues. Are we going to be able to be successful and push these companies to make real progress on this particular problem? Maybe, but there needs to be a recognition of there's only so much that investors can do.
Yeah.
But it doesn't stop us from raising the awareness on important issues.
Well, I imagine there's only so much manpower you have as well with the amount of companies out there that probably need a level of engagement, but you can't reach them all.
That's right.
So you mentioned there a couple of times net zero. So achieving net zero by 2050 is a target often spoken about.
Yeah.
How should we be thinking about this in the context of personally investing, but also just like asset management more broadly?
Yeah. So I guess the first thing to say is that net zero is not a target for any one investor asset manager, right? It is a goal that we as a community or the world is trying to achieve, so that we don't end up in a situation where both the frequency and the magnitude of extreme weather events will become unmanageable.
Yeah.
Right, and that's the idea of trying to limit temperature rise at below 2 degrees Celsius by 2050 is really critical. And the pathway to get there, to achieve that, is to try to get to what we call net zero emissions by 2050. To do that, it requires the whole economy to change the way we produce, consume, and move about, right? It touches upon every single sectors. And that change is going to be driven by technological, advancement, policy and regulations, and then also changes in consumer behavior. So as an investor, What we need to do is, with that in the backdrop, what are the investment risks and opportunities across all sectors because of the technological change, regulation, policy, and consumer behavioral change? So we have done a lot of work to create a what we call a carbon transition score. This allows us to assess how ready a company is for the transition to a low carbon economy. We don't just measure reduction or changes in greenhouse gas emission, because that's just one aspect of it. You also want to look at how much the company is spending on green R&D, green capex. So you want to have a little bit of a forward looking as well. And then a whole host of other issues like, water recycling, waste treatment, and all of that, because they are also relevant to low carbon transition. So that's the lens that any investor should take, right? Going back to the first question around recognizing the fact that the world is changing. Net zero transition is a big change that the economy is going through. Of course, it's going to create investment risks and opportunities, and that's why we should be focusing on it.
Are there particular industries or sectors that you've identified as like high risk in terms of being prepared for this transition to net zero?
Yeah. The starting point obviously is to look at sectors and industries that have the highest percentage of greenhouse gas emissions in terms of contribution to overall. So the likes of energy, agriculture, and then steel, cement, industrial processes, etc. I would say some of those, the technologies are available, like in the case of power generation, right? Renewables such as solar, wind are very well established, very mature. Costs come down a lot. There's a lot more work that needs to be done on the grid, electrification. Electric vehicle is another one, so transportation. Some aspect of it is quite well established, like electric vehicle, but there's a lot of discussions around sustainable aviation fuel. That is still very expensive, right? It's not yet ready for mass commercialization. So that I would regard as higher risk. So it's really about how ready the technology is for further commercialization, right? What's currently like at a cost scale, where the technology sits. So even within a sector, you can find different types of technologies at different stages. And so to me, like that's what determines which is higher risk versus lower risks.
One of the things that I'm grappling with though is that particularly now when, let's use aviation as an example, in this broader goal to get to net zero, but then these companies set their own goals as well. A lot of it is done just by buying carbon credit. Yeah. And the crux of it is that the business itself hasn't actually put much effort or the ability to actually change the business so that they are emitting less. They're just offsetting by buying credits. Yeah. I guess how do you see that playing out over the longer term? Do you factor that in? How should I think about that? Yeah, no, it's a good question. Offset should be used as a last resort, right, to really remove any residual emissions that you just cannot decarbonize away. There are industries where the technology is just nowhere near mature, or the technology has not really being invented, or it's just way too costly. Right. In those sectors, so like steel and cement is a good example, right? It's really, really expensive to produce. Not that the technology doesn't exist, but to produce green steel. There are a couple of like private companies in Sweden that are doing a really good job. They're not public listed companies yet. But the reason why they're able to produce green steel at a slightly cheaper rate is because abundance of hydrogen in Sweden, right? So it's very location specific as well. So in a sense, you do see that in some of those hard to abate sectors, some companies are setting slightly more ambitious decarbonization or net zero targets in the near term versus their peers. But they may come across situations whereby they overestimated their ability to commercialize these technologies, right? And they have two choices. One is to go back on their target and say, sorry, we just can't make it, have to roll back on these. Or be transparent about it and say, we still want to meet the target. So in the interim, because the technologies are not yet available and we'll continue to invest in it, but at the same time, we want to be able to buy good quality carbon credits from the voluntary market to offset our emissions.
So I don't think it's a black and white type of thing, right? It really depends on the companies. It depends on the sectors. The most important thing for any investors when we look at companies who purchase carbon credits is to evaluate the quality of the carbon credits. Because the last thing you want is they end up buying some credits that
degrade.
Exactly.
Yeah. I guess how is JP Morgan Asset Management taking their own steps to reduce emissions and hit net zero?
Two things. One is we have a lot of clients who have their own net zero targets.
Yep.
So a really important step that we've taken is to develop a suite of building blocks that they can use to get them to net zero. And that includes investment strategies that follow a carbon transition benchmark or a Paris-aligned benchmark, which could help them in the equities and fixed income portfolios. Similarly, having investment capabilities that allow them to invest in products and services that will help the world to decarbonize. We mentioned that there's always going to be residual emissions that you just cannot remove.
Yeah.
And this is where you need what we call negative emissions technologies. It could be mechanical, like carbon capture and storage, or nature-based, like forestry, for example. So we've also done quite a bit of things developing our forestry investment capability so we can offer that to our clients. So that's a really important part of our strategy, because at the end of the day, the money that we manage is not ours, right? It's our clients. So that's the first thing. Apart from that, for clients who may or may not have a net zero target yet, it's equally important because net zero transition is an economy-wide transition that's taking place. So we are engaging with companies who have set a net zero target to understand how feasible these targets are, what's their implementation schedule and plan. Is that going to be additive to shareholder value, or is it going to hurt shareholder return? That's really important. And then for those companies that haven't set a net zero target but their peers have, why is that the case?
Naughty.
Right? So I think the view that we have when it comes to net zero engagement with all the portfolio companies that we have across private and public is A, wanting to make sure that we are managing risks effectively, and then B, trying to identify who are likely going to be the winner in their sectors.
Jennifer, to close out, I want to bring it sort of back to the Equity Mates community and the individual investor. JP Morgan Asset Management have introduced some sustainable ETFs. There's the Climate Change Solutions Active ETF.
Yep.
T3MP is the ticker. So for investors looking to incorporate ESG into their portfolios, what advice would you have? How can we effectively, I guess, evaluate, think it through, and then also how does something like the T3MP sort of fit broadly into the portfolio?
Yeah, so I think it's an exciting time, right? On the one hand, we as individuals are worried about what the future is going to look like because of extreme weather events, droughts, floods, and all of these things. What that also means is that there's an abundance of investment opportunities. And what TEMP is trying to do is to identify companies who are at the forefront of commercializing some of these technologies and solutions that can help the broader economy to decarbonize or become more energy efficient. So not just in the energy sector, but also in agriculture, in transportation, in manufacturing, so across the board. And that's really exciting. It's, of course, on an individual basis, we hear stories like electric vehicle, investment opportunity, but it's more than just transportation or solar power plants. There's a lot more. If you just look at recently, utility companies, how aggressive they are in buying startup companies that are developing like carbon capture and storage. You know that this is really a space to look into. So that's what TEMP is trying to do. I guess the other advice I have is we spend a lot of time talking about if you want to be a good investor, you should think about these financially material ESG issues, right? Because the world is changing. There are newer risks that you have to consider. So in a sense, you want to look at, regardless of whether it's a ESG fund or not, You want to look at the information that's in the public domain, that's been disclosed by asset managers or your financial advisors. What is that they're doing in managing these financially material risks and opportunities, right? Because if they don't consider these issues, I don't think they can actually be able to capture the new alpha that we're all hoping to see.
Love it. Well, Jennifer, thank you so much for your time. If you're interested in learning more about TEMP or T3MP, we'll put a link in the show notes so you can find the information that is applicable to you. But Jennifer, for a topic that can be a little bit confusing or overwhelming or a bit sort of opaque, I've certainly learnt a lot today, and you've been able to make it a little bit clearer. So thoroughly enjoyed this conversation. Thank you so much.
Me too. Thank you so much.
You have been listening to an Equity Mates Media production. In the spirit of reconciliation, Equity Mates Media acknowledges the traditional custodians of country throughout Australia and their connections to land, sea and community. We pay our respects to their elders past and present and extend that respect to all Aboriginal and Torres Strait Islander peoples today. This podcast is intended for education and entertainment purposes. Any advice is general advice only and has not taken into account your personal financial circumstances, needs, or objectives. Before acting on general advice, you should consider if it is relevant to your needs and read the relevant product disclosure statement. And if you're unsure, please speak to a financial professional. The hosts of this podcast and their guests may have positions in the companies mentioned. Equity Mates Media operates under an Australian Financial Services Licence 540697.